What is the primary difference between a commodity index and an equity index in India? Here are your options. A. Commodity indices are based on spot prices, whereas equity indices are based on futures prices. B. Commodity indices in India are based on nearby futures contracts, whereas equity indices use stock prices. C. Commodity indices use rolling spot prices, while equity indices use fixed benchmark prices. Or D. Commodity indices and equity indices are both based on direct physical market prices. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Commodity indices in India are constructed from the prices of nearby futures contracts rather than the spot prices of the commodities, whereas equity indices track stock prices. Which of the following is an example of a total return index? Here are your options. A. An index that tracks only capital appreciation. B. An index that tracks only excess returns above a benchmark. C. An index that includes capital appreciation and any income generated by the assets. Or D. An index that considers only risk-free rate adjustments. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Total return indices measure both capital appreciation and income generated by the underlying assets, such as dividends and interest. What is the significance of MCX BULLDEX in the commodity market? Here are your options. A. It represents the price movements of energy commodities. B. It acts as a benchmark for agricultural commodities. C. It measures inflation trends in the commodity market. Or D. It tracks the performance of precious metals in India. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. MCX BULLDEX is a sectoral index representing the sentiment in the precious metals market, specifically tracking gold and silver. Why are commodity indices generally considered as total return indices? Here are your options. A. They include price changes of futures contracts and the income generated from rolling them forward. B. They exclude carrying costs and transaction fees. C. They are based only on physical commodity prices. Or D. They do not consider market fluctuations. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. Commodity futures prices-based indices are total return indices because they incorporate both price movements and income from rolling futures contracts forward. What is the primary role of index providers in the financial markets? Here are your options. A. To regulate commodity derivatives trading. B. To construct, maintain and calculate indices based on methodologies. C. To ensure that stock exchanges operate smoothly. Or D. To enforce government policies on market regulations. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Index providers develop methodologies, select index components, and calculate their values based on the performance of underlying assets.